Welcome to Value Seekers channel. The information provided in this video is for educational and entertainment purposes only and should not be considered investment advice. If, like many investors, you believe that gold and silver should be part of everyone's portfolio, but wonder what proportion of gold relative to silver you should own, then watch this video. We will see how sizing your gold and silver holdings can help you beat both metals. Indeed, the strategy we will examine generated a nominal return of 9% per annum, against 6.5% on average for gold and silver. As many precious metal investors know, the gold-to-silver ratio can be volatile and tends to return to its mean over time, alternating from a period of cheap silver relative to gold to a period of cheap gold relative to silver. This is the particularity we will try to exploit, not to time the market, but to set up an investment rule, which we would apply automatically. As the gold-to-silver ratio tends to reach 100 from time to time, sometimes more, let's apply this simple rule for the precious metal allocation of a portfolio. The percentage of silver should be equal to the gold-to-silver ratio with a maximum of 100%. The percentage of gold should be equal to 100% minus the percentage of silver. For example, if the gold-to-silver ratio is equal to 80, then 80% of this pocket should be made of silver and 20% of gold. In so doing, an investor will always overweight the cheapest of the two metals in order to generate excess returns. Now let's have a look at the returns of this simple rule since April 1969, assuming a monthly rebalancing and no transaction fees. The return is rather impressive compared to both gold and silver. While the nominal annual return of gold and silver were about 7.8% and 5.3% respectively, the return of this strategy ended up at 9%. However, please note that the return of gold and silver should be relatively similar over the long term, and the difference we see here is probably due to a base effect. Nevertheless, our strategy beats both, so its interest remains intact. Also, not only its return was far higher than the ones of gold and silver, but it was only slightly more volatile than gold and far less volatile than silver. Okay, nominal returns are quite appealing, but investors know that precious metals are stores of value and hardly produce returns over the long term once adjusted for inflation. Well, that's rather true, as anyone who would have invested 50% in gold and 50% in silver without rebalancing in April 1969 would have generated 2.2% per year in real terms. It's not zero, but not an appealing return either. However, using our rule, the real return would have been about 5%, which makes a big difference over the long term, and is already quite appealing, especially for an asset allocation involving no active decisions, just the application of an automatic rule. In comparison, the average return of 3-month T-bills and 10-year treasuries would have been 0.5% and 2.3% respectively over this period. Is this strategy perfect? Certainly not, as it will not protect you against any precious metal bear market, and it will not make you rich tomorrow. But it offers a sufficiently promising risk-return trade-off to be employed in a portfolio as a return generator and diversifier, especially in an inflationary period during which bonds can hardly play this role anymore. If you enjoyed this first video, please feel free to like, comment, and follow us. It would help us come up with new, interesting investment topics.